Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
And we are back. Episode 124, Carson's Facts versus Feelings. Sonu, we're going to do some math this week. We are titling this one. You're pretty smart at math, so I'm not too worried. Denominator Blindness. We've talked about this concept a lot. We're going to get into it because we keep hearing how bad the consumer is because there's a lot of debt. But it turns out you have to look at some other parts of that whole picture. Sonu, is it finally warming up in Chicago, though? It's warming up here in Cincinnati in a big way.
It's warmed up by about 40 degrees. We've gone from negative 10 to 30 degrees. So 30 degrees is still cold.
It's still cold.
When you come from negative 10, this feels like summer already. So,
I know,
I'm not
funny.
complaining.
I think yesterday cracked 40. I was like all excited. Oh, it's cracking 40 degrees. Are you kidding me? Like, who was possibly happy about that?
Go.
Yeah.
All right. Are we diving into math? I feel like last week we talked about reciprocals, and here we are now talking about denominators.
Yeah.
We have a math team going on.
Just get ready, everybody. Get ready. So again, this week we'll talk a little markets, right? Friday was the quote-unquote worst day of the year. Thursday and Friday ugly, but Wednesday made an all-time high, and it's just funny how quickly things change. Then we will spend a good deal of time talking about the consumer, the household balance sheets, again, denominators, numerators, picture's not as bad as they keep telling us. And then Uncle Warren Buffett wrote his annual letter over the weekend to his shareholders, and it was awesome. Sonu and I both had a chance to kind of look at it a little bit. We've got some thoughts, obviously, at what Uncle Warren has to say. And it was an amazing letter, as always, if you haven't had a chance to read it. I think I saw the headline. This is one of his shorter letters he's written in a while. Is that true, Sonu?
It did take me, it didn't strike me until you just mentioned it. But yes, it didn't take me that long to finish it this time.
Yeah, I think I saw it was one of the shorter letters he'd done in a while. But we'll talk more about that near the end.
Yep.
So first things first, listen, last Wednesday, S&P makes a new all-time high, the third all-time high of the year, on the heels, obviously, of nearly 50 or so approximate all-time highs the year before. Obviously, 2024 was a good year. Thursday, kind of weak-ish market action. And then Friday, there's a couple of reasons, maybe the market's just due for a break, but down 1.7% on the S&P and the Dow, actually. That was
why was that? I think I lost track of what happened on Friday. I was doing my stuff, and next thing I know, wait, market's down 1% and then 1.5%.
There's a few theories out there. I've got so many notes written in front of me here. I can't quite find it. I know United Healthcare was like 250 points or so approximately on the Dow. The Dow was down like 700 or so. That's what it came out to. And that was, some issues with the government and United Healthcare. I guess I'll just leave it there. At the same time, what we've seen, and we'll put this chart up on the screen right now, we have seen extreme weakness so far this year on the S&P 500 on an annualized basis. That's annualized. It's a small sliver of the year. I get it. But Fridays are down like 80% annualized. Monday's not doing very well either. It's the rest of the week that we do well. I think, Sonu, in a news-heavy market like we're living in right now, that's what we tend to see. Weakness on around weekends, and it's what's happening. Do you have anything else you want to add there?
And we're recording this on Monday, 24th of February, and I see more red on the screen today. So still playing to form.
Yes. Yeah, no, that is true.
Why do you think people, is it because headline driven, people are worried over the weekend? You know what? We may get more announcements over the weekend. I must say over the last 2 weeks, we haven't. So I've been, happy about that. But maybe, is it just that nobody wants to carry big positions into the weekend and into Monday?
I think so. I think it's almost that simple in a way. You think back 5 years ago right now. By the way, 5 years ago right now, right? That's when COVID was really starting. The market was really getting volatile. I remember, and I know you do too, and a lot of listeners do, those Friday afternoons of the last part of February and the first couple of weeks of March, or really all of March for that matter, were just the wildest things. I mean, maybe you were up or something, but then by the end of the day, it was such extreme volatility those last couple hours. Unfortunately, we're nowhere near that. But what I'm saying is you do get more volatility. You do get weakness. Some of the strongest bull markets, some of the best years we've ever seen, Sonu, were really strong on Friday. Historically, Monday's not that. No one likes Monday, especially the stock market. It's usually a weekday no matter what, okay? But
unless
Fridays,
you have children.
Yeah, that's true. That's true. See, go to school, get a little break here. Yeah. It's funny. I was doing some work and I got a call from my daughter's school. She's in high school, junior, and I text my wife because we were like a team meeting. This is like an hour ago. So I text my wife, says, school just called. I let it go to voicemail. Usually like 9 times out of 10, that means they didn't go to school that day because they were sick. And I was like, did Susanna go to school today? She's like, no, she's sick. So I had no idea. So anyway, there we go. Got a kid here apparently that's sick. I had no clue. But once they're 17, I don't really hear from her anymore. Anyway, going all over the place here. Let's see. What else want to talk markets wise? I mean, where else want to go with this? I mean, that week. How about this? So we had weakness on Friday. Some of it was maybe a little kind of a weak outlook as it pertained to Walmart. I think it was TD Cohen had a report that said you're maybe seeing some weakness with AI as it tends to leasing. I don't know. I mean, I think there was one more that kind of was out. There's a couple. Believe me, there's more than those. Those are some of the headline ones that said that's maybe why Friday was weak. I think it's late in the month of February you tend to get weakness. On Fridays this year, you tend to get weakness. The first quarter of a post-election year, hopefully if you listen to this podcast, I know this sounds very new. We've talked about these things. You tend to be kind of weak, choppy first quarter of a post-election year. It's just kind of where we are. Still bullish, yes. Still optimistic, yes. But maybe we're just due for some chop and some frustration. What do you think?
You know what's doing well? International stocks.
Yes.
How about them? Right? Like everyone's hated on international for so long. And, this could be, more of the same. We saw this in, ironically, 2017. 2017 was the last year, I think, when we had a full, big calendar year. Outperformance by international stocks. Both developed markets and EM. Outperformance relative to what happened in the U.S. equity market. And what else happened in 2017? We didn't get to, there was talk of tariffs and stuff, but the dollar went down.
Yes.
Right? I think the dollar easing is obviously a tailwind for international equities. And I, looking at the data, I follow all the macro data and stuff like that. I haven't seen a lot of improvement with respect to how these economies are doing. But again, goes to show the economy is not the stock market's not the economy. Look at the German DAX, right? The DAX is just hitting new highs one after the other. I mean, there was an election over the weekend as well. The Conservative Party won. The same party of Angela Merkel, by the way. I mean, it was her party that won the election and once again. So, but if you look at manufacturing PMIs, now in the US, you and I have kind of poo-pooed manufacturing PMIs with good reason. They pointed to a recession, but we've not gotten a recession. You kind of made fun of it, right? But manufacturing PMIs, I think, do matter for the rest of the world because manufacturing is a bigger part of the economies, especially Germany. And it's gotten slightly better, but it's still bad. The manufacturing sector, especially in Germany and places like that, is still under contraction. But the stock market's doing something else. I think part of it is maybe there's some hope that, that Russia-Ukraine thing could be solved. I think same thing in EM, emerging markets. China's going gangbusters once again. We'll see when Lucy pulls the football back. But, over this past weekend, I think Alibaba, right? Remember when the head of Alibaba, Jack Ma, was it 2 years ago, 3 years ago? So nobody heard from him.
He vanished.
He disappeared. He vanished. Right?
Yeah.
So people didn't know what happened. Well, he's back. He was at an event with President Xi, a meet and greet with business leaders. There were a lot of people from China's tech industry, including the guy who founded DeepSeek. So he was there too. So they're making a whole show and tell about, we are supporting our tech industry. Who knows how far that goes, but that's markets like that. And this is part of the reason where I think you can't just, follow fundamentals, right? I mean, I look at the macro data. You kind of have to follow the lines on the chart. And that tells you something about sentiment. The sentiment positive, negative, and the line on the chart is a line on the chart and tells you maybe more than a lot of other things in the world.
No, exactly. One other thing on Friday, I knew I had it in my notes. I just had to find it. Steve Cohen was on CNBC, fairly negative, talking about tariffs and concerns, and anyway, all that stuff swirled together caused that big drop on Friday. Now, I do want to point out again, Sonu, because we kind of glossed over it, but I think it's important to remember. On February 19th, 2020, the S&P 500 peaked, hit an all-time high. Nobody knew it at the time. That was the last all-time high for a long time. Had a 34% 5-week bear market, just one of the most vicious bear markets, quickest bear markets we've ever seen, obviously, with the 100-year pandemic shutting our economy down. And then you can look back and we're hitting like more all-time highs. But let me just take a little more context on this, Sonu. The S&P 500, on that day it peaked, February 19th, 2020. All right. Since then to just like last week, up an annualized over 12%. Okay. That's over 80% price return, darn near a double in a total return basis. 100-year pandemic, 34% bear market. And then you go to 22, which was a horrible year for investors, right? Stock market was in a bear market, but bonds were down double digits. So usually stocks zig, bonds zag. That didn't happen. And gold, like, I think it was up a tad or maybe flat-ish. So it's not like a lot did well in 22 for you investors, especially diversified portfolios out there. And now here we are 5 years later. And if you told somebody all that stuff would have happened, I don't think anybody, including us, in their right mind would have said, I bet stocks double on a total return basis. But it happened, right? What do you think?
No, it just gets to the resiliency of companies in the United States more than anything else. I mean, we were just talking about international. I don't think international equities did anything close to that. But look, you and I have been talking about the productivity story, but it also gets to where does productivity come from? It ultimately comes from everybody in the economy. Firms are getting more productive. And I think that's the story here. Companies have adapted. And yes, the Fed raised rates from 0 to 5.5%. That I'm not saying that's not a headwind. It is a headwind. I mean, for like housing struggling right now because of elevated mortgage rates. But for the most part, companies are like, if you look at a small business sentiment survey, you think, okay, with rates as high as they are, their biggest problem would be higher interest rates. But no, the biggest problem is still like higher costs to an extent, and then quality of labor. And quality of labor is something businesses, especially small business, always complain about that because, they have to pay more to find good labor, and maybe they don't have the capacity to do that, right? So it almost tells you that when small businesses are complaining that the biggest problem is the quality of labor, it's sort of like we've normalized, right? That's one way I look at it.
Well said. You mentioned productivity, and I don't know how you quantify these things sometimes when it comes to productivity. Because when I first started doing podcasts way, way, way back in a past life in 2017, maybe it was 2018, we'd have to go into the studio at work, and there'd be 4 or 5 people in the room, and you'd have all this stuff, and it was a big production, right? Now, like you here, me here, we've got our producer Josh, and we can do it from anywhere. We just thought, I'm going to record one, and then a couple of weeks from a hotel room at 6 a.m. in Arizona, you're going to record one over here. Just give us a couple things. Like, that's productivity. That's just one example of it. It just came to my mind though, because we're doing this. Like, there was a past life where you and I had to be in the same room. Okay, to do a podcast. That is nothing like that anymore, as we know. So that's productivity. I don't know how you really quantify that, but trust me, it's happening all over the place as it pertains to technology and things. So this productivity theme that you've been talking about for well over a year and a half, we're looking at 6 quarters in a row of strong productivity. And I mean, we've talked a lot about it, but you don't think it's going anywhere, right? This productivity boom we have is sticking around.
I think as long as the labor market doesn't fall apart, as long as you don't get a recession, I think this continues. How does this productivity story get killed? I think if we get a recession, that's the end of it, right? And that's what we saw in 2001, 2002. What killed the productivity boom of the late 90s? It was that recession. And by the time we got to 2004 or 5, productivity is definitely slowing down. And then over the next 15 years, we didn't get a lot of productivity growth. It was averaging about 1.5% or so. So I think that's what will eventually. It's not easy to kill productivity gains, right? I mean, we know, like, let's play this out, right? Right now, we are seeing above trend productivity growth. Say we don't expect this, but say we get a recession. During a recession, you get false productivity because people get laid off, and then companies are still like, oh no, We had 100 people. Now we have only 80 people. Now you 80 people have to work harder. So it looks like there's more productivity, but it's not. It's artificial, right? So that carries on for a little bit too.
I believe you call it empty calories, right?
Yeah, empty calories. Yes,
like a Snicker bar, empty calories.
Empty calories. I don't want a Snicker bar as empty calories. No, it makes you feel good, though.
Oh, trust me, I'm not saying I don't like empty calories. Look at me, I like empty calories.
I was just thinking, like, if you and I get together in a room, I'm glad in a way that we don't have to get together every week, because that would be. No. I don't think that would be great for the healthcare system or my arteries.
We hang out in Texas in a couple of weeks, and we've done some research on where we want to eat. Let's just leave it there. Yeah.
So that's a margin expansion for Dallas restaurants right there. So Sonu and Ryan are in town.
Which, by the way, I mean, believe me, we're all sidetracked now. Let us know your favorite burger joint. Facts versus Feelings. VS, Facts versus Feelings at carsongroup.com. I was in Columbus last weekend. My daughter, Susanna, had a state championship for her cheer team. Turpin High School finished 5th in Division 2, which was really, really cool in their little bracket, which is awesome. And there's a famous, so I drove 2 hours and 8 minutes there and 2 hours and 8 minutes back to watch a 4 minute thing, but it was worth it. It was awesome. I got to listen to some podcasts and stuff along the way, so it was great. But I did go to Thurman's, and if people in the Ohio area know anything about burgers, Thurman's is an institution. Thurman's is awesome. I called ahead because there's only so much time, and listen, if I'm that close, I got to go. So I called ahead. I won't be in 30 minutes. Put this burger in, because the burgers take like 30 minutes. They're so big. I walk in, there it was at 8. Got my burger out the door in 20-25 minutes. So thank you, Thurman's, for making all that happen for me. It was awesome.
That's what you drove 4 hours 16 minutes for. See, I remember that. 2 hours 8 minutes.
No, I didn't.
4 hours 6.
No, I didn't say that.
Not for Susanna's.
Okay, guilty.
Let's
guilty. You got me.
Hey, Thurman's is top of my list too. I like Au Chevalier, but Thurman's would be right up there. I would say both of them together. You know what? I'm going to do that.
Boy, that'd be a heck of a day. I don't know if we'd make it, but it'd be a good day.
Thankfully, they're in different cities.
Yeah, it would not be a productive day. Let's put it that way. Would not do much. All right, so I wanted to bring this up here. You mentioned we're kind of bouncing around, but these are all concepts I think important. Confidence. We've got CEO confidence at 3-year highs. All right. Yet if you look at individual investors, they're like panicking. Stock market's hitting all-time highs. You've got 3 weeks straight of bears above 40%, Sonu, on the AAI poll, with making new high. That's never happened before in the history of this thing that goes back to 1987. You've got the Global Fund Manager Survey. Always it's a mouthful to say. Bank of America shows the smallest cash allocation in 15 years. 89% of them are telling us that stocks are overvalued, yet they're extremely, they have small cash positions. So apparently they're investing in overvalued stocks. We're not saying it's overvalued, but that's what the survey said. Then you've got put to call ratios, which to be honest, aren't showing much fear at all. You've got the NAAIM active managers. They're pretty bullish all of a sudden. I mean, I can tell you anything you want. I know the consumer stuff on the Michigan Consumer Confidence is saying one thing, and this confidence saying that, and you can get into that. It feels like nobody has a clue what's going on out there. Because I can tell you people are worried, or I can tell you people are over the top bullish. The truth is usually somewhere in the middle. When I look at all these sentiment gauges, I can't make heads or tails of it. What are you seeing?
Maybe that's the story. Like everyone's confused. It's like everyone's all over the place, and there's a little more uncertainty in the air. I mean, I looked at that CEO confidence survey as well. They're like, I think accurately probably described as cautiously optimistic.
Yeah. Sounds like a guest on CNBC.
I know.
I think I'm on tomorrow. I'm probably going to say the same thing.
You say cautiously optimistic. Aren't we all the time?
Yeah.
Right? But no, I think there's enough to, like, there are worries and things like that. But I think this gets to the title of the episode too, Denominator Blindness. Like, I think a lot of the worries are probably focused on the wrong things. I mean, that, in our 2025 outlook, we said there are risks and threats and things like that out there. Yeah. We're not completely blind to that, but I don't think it's like the usual things where people talk about, it's credit card debt, household balance sheets. That stuff is not, I think, what I'm worried about right now.
Yeah, and we'll dive into that the second part of this conversation. I don't know. Anything else from a oh, maybe this. So we did a morning call with our partners. Had a big turnout this morning. So thanks to all the partners at Carson
And they
Partners
stuck
that
around
listened.
beyond the hour.
Shockingly, Sonu and I talked longer than we were supposed to, but everybody stuck around. There's 11 S&P 500 sectors as of last week, as of Friday. 8 of them are outperforming the S&P 500 on the year, and 10 of 11 are positive on the year. So yes, Friday was an ugly day. Thursday was kind of ugly as well. We'll see by the time you listen to this what the start of the week looks like. But that's still a lot of breadth and participation, in my opinion. What do you think?
Actually, I have a question for you on that defensive. And you showed a chart on this, which was pretty cool, I thought. So you picked 3 sectors, like utilities, consumer staples, healthcare. Now, utilities over the last year, they've been tied to the AI story and nuclear and things like that. Okay, but set that aside a little bit. And then healthcare's got some growth type of characteristics too. But staples doing well, right? Staples is right in there. And how are you thinking about the fact that these sectors are starting to show up, with green?
Yeah, because what I looked at, I guess, was a relative basis. So how those groups are doing divided by the S&P 500. Because, I mean, the market might be up, the market might be down. But what we're trying to do with the models we run for our Carson partners, we're trying to find the groups that are outperforming, right, the S&P 500. And what we've seen on those defensive areas, they obviously lagged for a good deal of time. All of a sudden, early this year, that stopped, right? They have stopped lagging. Not necessarily, doesn't mean they're outperforming, although we saw Staples outperform by a wide margin on Friday. I guess the answer is if we continue to see low volatility, if we continue to see Staples leading, that's a sign that maybe the market is changing a little bit. Maybe there is some more defensive leadership that's taking place. We'll be very clear we're not there yet. But also, I mean, just the fact the first half of a post-election year, maybe it is going to be a little choppy, a little frustrating. We're on record. I'm on record to say I think there's going to be at least a 10% peak to trough correction this year. That's not that abnormal. Okay, most years tend to have a peak to trough correction of 10%. Maybe it's going to be early in this post-election year. So those are kind of some things we're looking at. And I'll always remember this, the fourth quarter of 2021. Now think back to 21 for a second. Government gave everybody money. Crypto was going crazy. Everybody's day trading. Everybody's opening up accounts. Everybody's gambling. Everybody's doing all this stuff. Everybody's just money. It's easy money. And then a funny thing happened. Everything stopped going up at 22. That happens, okay? That's what happens when things get too easy and everybody makes too much money and everybody has a little too much fun. You have fun at the party, you have a hangover the next day. 22 was a major hangover because bonds did terrible and the stock market did absolutely – the stock market had a bear market. It did pretty poorly also. But the fourth quarter of 21, even though everybody's excited, Sonu, we saw leadership from utilities, from staples, from low vol. Some really smart people I know and respect a lot were talking about this. And I remembered seeing it. And I was like, I'm not so sure. Oh, I don't know. And then we know what happened. Right now, the war took place, obviously, in March 22. Sure. Different things happened. But there were some – and this, I want to be very clear. These warning signs are taking place months before the trouble really started. I mean, people were talking about
And it was months before, 6 months, 7 months before the Fed really got going in June of 2022, right?
Exactly. Yeah, that's I think I forget what Powell said. He made some comment about, we're not going to do anything, and then 2 days later it totally changes too. I forget the exact way that went down, but yeah, that was like things were happening in a hurry in the middle of 22. But the other side was the market gave warnings well in advance. If you listened to it, you paid attention to it. A lot of smart people were looking at it, and so that always is in the back of my head. So believe me, if we continue to see the low vol defensive areas leading on a relative basis, then I'll be we'll be watching it. We'll be looking at it. For now, I think it's more just kind of some shopping around, some consolidation, but it clearly is something that matters when you manage portfolios. And so there's something we did in some trades recently, kind of a barbelled approach with high vol on one side and kind of momentum on the other. Momentum did get hit really hard.
Low vol on one side.
Yeah. Low vol. So apologies. Low vol on one side, momentum on the other. You want to talk about that a little?
Yeah, I think it's, I don't want to say have your cake and eat it too, but no, it is a barbell. And we've talked about broadening markets, but broadening markets, I mean, we still overweight equities, but we want to spread that love around a little bit. And one way to do that is we still like us small caps, mid caps. We have more mid caps than small caps, admittedly. But we like both momentum. And right now, if you think about momentum, everyone thinks about, it's technology, right? Actually, a lot of the stocks within momentum are financials. Right. And that's a sector we've liked. So it's very cyclical. Right. But on the other hand, like instead of putting all your eggs into that cyclical basket, like, wait a minute, how do you offset that with low volatility stocks? Right. It's not just staples and things like that, but even across different sectors. Right. Whether you talk about even financials, the technology. Like we're looking at the lower, more stable companies in those areas. So that's what we mean by low vol on one side and then momentum on the other side. So again, gets to the fact that we see broadening out. And into global equities, we talked about that a little bit. We're not zeroing out global equities. We are underweight, but it's not a big, massive underweight, right? Like we probably have more international equities than a lot of other people do. Like I know a lot of people who have 0% international. I mean, just even my personal portfolio, right? Like a lot of my money's invested in some of the models we manage. But 401k, it's 70-30, 70% US equities, 30% international stocks. I don't have any bonds. I mean, I have cash and things like that, and the home equity, obviously. But otherwise, the 401k is fully 100% equities, and that's 70% US, 30% international.
No, well said there. And that's kind of, we've talked a lot. We still like the U.S. more. Yes. Are we underweight emerging markets? Yes. Developed international. We've got some exposure, not a lot, but again, we have some, right? And again, what we've seen, it's just fascinating to me. Europe, the rally we talked about already, but I mean, Germany is a huge cog in the global economy and a huge cog, obviously, of Europe, and the DAX sitting all-time highs. Yet the headlines I keep reading out of Germany are how bad everything is. I mean, this is interesting divergence, and kind of the way I learned it, that's probably a bullish signal. If everybody hates it, but it's going up, everybody tells you how bad it is, but it's hitting new highs. I'm not saying that's something you all want to go all into, but maybe developed international kind of makes sense to have a little bit in a portfolio, just like we do for the money we run for our partners, right?
Yep, exactly. You never want to throw anything out of them because you can never be sure, right? Like we make our calls. We never like 0% chance of a recession, 100% chance of whatever good thing may happen, right? Like even a recession, there's always some unconditional probability, as I like to think about it, like 10-15%. Like you never know where a shock could come or what. Like we just talked about COVID, right? 5 years ago today, right? That's when it started getting rumblings. People still didn't believe it. But then, boom, we got like this massive collapse in equity markets, massive collapse in the economy. And then things came back. And then again in 2022, boom, inflation, right? We had the Russia-Ukraine war. So, yeah, I don't think you can ever be 0 to 100, 0 or 100. You have to be somewhere on that spectrum and position your portfolio accordingly, right? You want exposure to different pieces of the market. And asset classes too.
I mean, you can be 0 to 100, but obviously we manage real money. We manage people's money, so we're not going to do that. We think, again, having a diversified portfolio with some tilts and some movement here and there makes a lot of sense, and that's how we see it. Now, I will also say, if you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback. Also, let us know your favorite burger joint, because this is something, it's like, religion, politics, sports, favorite burger joint. These are things that some people say you shouldn't talk about, but I guess we'll
keep collecting these, depending on which cities we get responses from. And like next time you and I go somewhere, like, maybe that's one to hit up.
No, exactly. But facts versus feelings, VS feelings at carsongroup.com. All right. So I think we hammered the market enough there. Let's talk about, again, the title of this week's podcast, which is Denominator Blindness. Because Sonu, we were told with some of the recent data that just came out over the last week or so, 1.2, another new record, 1.2 trillion in credit card debt, all that 17, you've got the exact number, 17 something trillion dollars of total debt, new highs, all this debt. The consumer's just awash in debt. Everybody's just in trouble. Everyone's just using credit cards to spend on things, and everything is going to fall apart and crack. We've been told that for a long time. Talk to us about why you should pay attention to that denominator, not just focus on the numerator.
Yeah, look, household debt rose 0.5% in the fourth quarter of 2024. By the way, that was the slowest increase in 6 quarters. Right. So just before we normalize it with a denominator with basically disposable income, I just want to say, like, household debt growth has been slowing down. And now you think, okay, how much of debt is out there? How much debt do households have on their balance sheets? Aggregate total, right? $18 trillion. Right. The U.S. economy is about 29 trillion. Right. But $18 trillion in debt. Mortgage debt actually makes up the big chunk of that. It was up close to 13 trillion. It was up just 0.1%. People are not taking on a lot of mortgages because mortgage rates are 7%. So that's one reason debt is not increasing as fast as it maybe was a year and a half ago. Yeah. Auto loans make up about 1.7 trillion. Credit card debt, which is usually what the headlines scream about anytime we get this report from the New York Federal Reserve. That's 1.2 trillion. 1.2 trillion out of 18 trillion.
Okay.
It's not a lot, right? So it's less than 10% of it, right? But then here's the other thing, disposable income. Here you get to the denominator, right? You have to normalize, especially if you have to compare debt across time. Right? You can't just compare, today we have $18 trillion. 6 years ago at the end of 2019, we had maybe 14 trillion or whatever that number was, right? No, nominal GDP was going up as well, right? That means debt is going to go up too. So that's why I normalize it with disposable income. Across 2024, overall household debt grew 3%. Disposable income grew 5%. Credit card debt grew about 7%. Now we're comparing it to 2019. Household debt grew by close to 4.5%. Disposable income grew by less than 3%. It was about 2.7%. So already, we're looking at 2024 where disposable income grew faster than household debt. By the way, for the second year in a row, right? And back in 2019, credit card debt grew by about 6.5%, 7% as well. Similar, not that much different from what we saw in 2024. But see, the key is incomes. Aggregate disposable income, like I said, grown faster than overall debt for the second year in a row. You have to normalize it.
And this is just data that is public, is free. Now, I know
it's free too,
it's
right?
Free. Like it's literally free. Yet we continue to hear just how bad everything is. Now, here's the other side to this, or maybe an added dimension to it. It's all the bottom incomes, the top bottom 10, 20, 30% of income earners, Sonu, are the ones that are racking up all the debt. They're the ones that are just over leveraged. It pertains to debt to equity. You, again, with public data that anyone can use, dug in, and that's not really the case, right?
Yeah, you look at, so if you look at the overall aggregate household, by the way, when you talk about all this debt, 18 trillion, that's aggregate. So then you look at, let's look at the aggregate assets minus liabilities picture, right? Right now, we talked about this in our outlook. Assets are running at 851% of disposable income. Liabilities, 96% of disposable income. By the way, in 2019, it was about 101, 102% of disposable income, liabilities. So net worth, assets minus liabilities, is about 755% of disposable income. And then you get to what you said. Everyone's like, no, that's just aggregate. You have pockets, especially lower income, that's really doing badly. And I'm not denying that there are pockets of struggles and things. There always is, right? But then that's why we compare apples to apples to history. And liabilities as a percent of assets for every single income quintile we look at, right, is lower than it was back in 2019, which means every single income group is less levered than they were relative to 2019. And 2019 was a high bar. Remember what happened in 2019? It was the end of a decade of deleveraging. Okay. After the financial crisis, 2008, 2009, even 10, stock prices went down, home prices went down, and households had to shore up their balance sheets once again. And it took them a decade to get back to where they were. And they were really conservative. And right now, so when we compare it to 2019, we are actually comparing it to a very conservative era of household leveraging, or deleveraging, I should say. And things look good relative to that, right? You take the bottom income percentile, 0 to 20, right? Liabilities as a percent of assets is right now 14.7%. In 2019, it was 16.2%. 20th to 40th percentile, it's 17.6% right now. Liabilities as a percent of assets. In 2019, it was 22%. You take the median, 40th to 60th percentile. Right now, liabilities as a percent of assets is 18.5. Back in 2019, it was about 20.7%, just under 21%. So like I said, everywhere we are lower in terms of how levered the households are.
Well said. And some of the stuff you just talked about, obviously the numbers are updated because they're new, but we've been talking about these concepts for a long time now, well over a year, that the households and consumers are in much better shape than they keep telling us when you turn on TV and you read newspapers. And like I just the real world stuff, like I get to travel a lot, right? Every airplane's packed. Every airport is full. Every nice steakhouse is full. Every restaurant's crowded. Every hotel is full. I made the joke in late 22 when people were literally spending tens of thousands of dollars when those Taylor Swift tickets first went on sale on this very podcast. I said, Sonu, how in the world can we have a recession when people are spending all this money, and then it's a rolling Super Bowl that's going to come in 6 months, that summer of 23, everywhere it went. And literally in May of 23, the Philadelphia Fed had a report that said the economy in Philadelphia was better in May because Taylor Swift came for that one long weekend. And it's kind of funny to joke about, but it's true. I mean, and again, that argument of, well, people are just using credit cards for everything, because no, the data tells us that people's net wealth is higher and increasing more than that credit card debt. Now, some people have had a lot of credit card debt. Some people have lost jobs. We get all that. But as stewards of assets, our job is to look at the big macro picture. And we've been overweight equities for over 2 years. We're still overweight equities because we still see households and balance sheets in pretty darn good shape. We haven't talked about corporate America's balance sheet. They were all preparing for that recession that everybody talked about. So they got lean, they got fit, they got all this and that. And that's why, corporate America's balance sheets are still in really, really good shape as well. Anything else you want to talk about on households, balance sheets, denominators, numerators, anything, math, pi, anything, 3.14?
Oh, we have some special pi stuff coming. We'll save that for March.
I mean, if you guys could only know what we know is coming on Pi Day, it's just unbelievable. We couldn't have planned it better if we tried.
Oh yeah.
We couldn't have planned it better if we tried. It's impossible, but it's coming.
On credit cards, here's the thing. Look, if people are in trouble, what would happen? Mm-hmm. The first thing credit card issuers are like, oh, you know what? We are cutting back your credit. We're seeing the opposite, right? Credit card debt rose by about $53 billion in Q4, but credit card limits rose by $98 billion. So credit card balances, it was more or less unchanged, right? So credit utilization, how much of credit are you using relative to how much you can use? That was unchanged at about 24%. And that's where we were before the pandemic. Home equity credit utilization, right? Home prices are going up, so equity is growing. Mm-hmm. Home equity loan credit utilization was unchanged about 40%. The historical average is about 51%. And as I was talking on the call with our advisors this morning, this is, I think, the main dry powder that's in the economy. Nobody's tapping into home equity loans yet. And I'm not saying you should or shouldn't. I mean, it's a personal decision. Mm-hmm. Right now, in aggregate, people aren't doing that because interest rates are high. But think about what happens if interest rates come down. I think that's when we start to see some of this dry powder coming out of home equity, because people are like, wait a minute, now maybe I can do the renovation for the kitchen or something. I can pull it out because my home price has gone up from, let's say, 500,000 to 700,000 over the last 4 years. And I haven't been able to access that because I don't want to pay 7-8% for a home equity loan, right? So I think that's a potential tailwind that's out there, right? If interest rates go down, I think we see some of that. So, but again, all this is not to say there are no problems, right? The very fact that interest rates are high now, that's, I think, crushing housing. We've seen some housing numbers that are bad. And I think that's a difference or will be the difference this year. I don't think we see 3% GDP growth. I think we see somewhere close to 2%. That's not a bad thing. I don't think that's a recession. Remember, 2% GDP growth was what we got between 2010 and 2019. Yeah. And the equity market did gangbusters. Yeah, exactly. Now, which part of the market may do well may change based on that, right? And that's why you don't want to put all your eggs into one basket one way or the other. But still, 2% is not bad, but I don't know that we're getting 3% growth. That could be the difference.
Sonu, have you seen the price of eggs? Do not put them all in one basket. If you drop that basket, Anyway, some other data. I just noticed this on X over the weekend. Credit scores of the 50th percentile. So again, just kind of 50th percentile of consumer credit cards continues to increase. Now 766. All you got to know is we've got data going back like 15 years. That's the highest credit scores ever, at least in 15 years worth of data, again, for kind of your median consumer out there. So that is just some other ways to look at it. And the one I love that you pointed out also, again, just data that comes out, the number of bankruptcies and foreclosures, I believe, if I'm correct here, both dropped in the fourth quarter. I think bankruptcies have been down 2 quarters in a row. Did I get that right? You want to build on those?
Exactly. Foreclosures fell about 1% in Q4. It's right now running 42% below 2019 levels.
Wow. 42%.
And then you think, okay, hey, everyone doesn't own a home. Okay, fair enough. Okay.
Sure.
But 66% of American households own a home. Right? I mean, not seeing foreclosures as a problem here. Bankruptcies, it fell 7% in Q3, fell another 3% in Q4. Right now, it's running about 39% below 2019 levels.
Yeah.
Again, it tells you how strong household balance sheets are. Again, if consumers are stressed, especially even lower pockets of income, things like that, what would you see? You would also see collections going up, right?
Yeah.
Only 4.6% of consumers had collections against them in Q4. That was actually down from the end of 2023. A year ago, it was 4.7%. So we have 4.6 now. It's slightly lower. At least it's not going up. At the end of 2019, it was 9%, right? 9%. We would double that, right? If there, like I said, if there was a lot of payment distress amongst households, I think we would have seen this metric go up, like collections go up. We're not seeing.
Well, funny little story. I think we were one of those. Now here's why. No, it's not as bad as it sounds. It's a wife and a husband not communicating properly. So my wife Emily had I don't know, she had something last year. I don't even know, some doctor thing, couple $1,000. I got like on a payment plan with them. I said I'd pay $300 a month, whatever. This is like last August. Okay. I don't exactly know what happened, but somehow the credit card it was linked to or something stopped paying it. Believe me, I didn't even know. I thought it was set. Emily's getting these emails apparently saying you're not paying this. I guess she didn't notice it or something. I don't know. Eventually,
sure, because now Gmail puts it all into a different folder.
I don't know. So like literally like a couple of weeks ago, she got this really frightening call from a collection agency about how I hadn't been paying your bills, and she's mad at me, and I'm like, I don't know what this is. So I call, and that's pretty much what happened. Was I thought we were paying it every month. I guess we clearly weren't. All the emails are going to her. She didn't. I don't know. So we were one of those. Apparently, maybe that'd be first quarter. Maybe we're first quarter. We're going to be on the collection agency stuff. So anyway, but
then Q2 we dropped. So.
I quickly paid it off. And how much do I owe you? They said like $1,200, whatever. Here's $1,200. Just make it go away. I don't, whatever, because I don't want her getting any more calls, because that's not going to be good about the collection agency under her name. So anyway, so maybe some of them can be an honest mistake as well. It just happened to the old Detrick clan. Not communicating properly. Anyway,
what they say? Happy wife, happy life. So
she was not happy that day. So she was not happy at all. That was not a good day.
Like you dinged her credit score of all.
Well, no, I confirmed that though. Here's the thing. I actually asked, I said, is this going to hurt her credit score? They said, no, this isn't going to the credit agency yet. We're a collection agency. It doesn't go to so I didn't hurt her credit score with.
Oh, good.
Anyway, it is what it is. You know what? I want to talk about Warren Buffett. Anything else you want to add on Denominator Blindness? We're going to finish up talking about Uncle Warren.
No, I think we put a blog out there. It's carsongroup.com/research. You'll see the stuff on credit cards and Denominator Blindness and household debt and all that fun stuff if you want to dig into it.
Yeah, because I mean, this is a question. Yeah, and it's amazing the blog you did, and the work you do, and hopefully the work our team does as well, pushing back against this narrative that we are aware the concerns and worries are there. But just because credit card debt's $1.2 trillion, that doesn't mean everybody's just maxed out their credit cards. In fact, when you look at the data, people are not maxing out their credit cards nearly at all. There's still a good deal of equity on credit, or a good deal of credit available on credit cards. I'm trying to say. All right, so Warren Buffett's annual letter came out to shareholders, and I'm not a shareholder, but I quickly got to read it as well. So, I guess it's to share with everybody just as quickly. What are some high-level things that you took away from reading Uncle Warren's letter there, Sonu?
I'm going to write about this. This will be on the blog tomorrow, carsongroup.com/research. He still doesn't like dividends. Like, he likes companies paying him dividends. He doesn't like paying out a dividend, right? Yeah. And that gets to the tax efficiency or tax inefficiency of dividends. I'll write about that. But the other thing is, we've been talking about like Mag 7 and all of that. The Mag 7, like these stocks have been doing gangbusters over the last several years. Buffett's, made some investments in Japan. I wrote about this a long time back. I'll bring it back maybe one of these days. I'll write about it again. I put it in a daily note for our advisors. Back in 2019, Buffett invested in 5 Japanese companies. And these are like, I won't even try to say the names. These are 5 large Japanese conglomerates, kind of like Berkshire. They own like everything, right? All sorts of things, right? And by August of 2020, for his 90th birthday, I think they ended up getting like a 5% stake in each of these companies. So now, fast forward, last 5 years, or let's say how many? 4.5 years, 3.5 years. Yep. Like you go from August of 2020 to December of 2024. These 5 companies on average have gained about 273% total return. Average across, just straight away, plain average. Wow. You look at the Mag 7, during the same time, it was up a lot, as you can imagine. Average is 215%, right? So these 5 stocks, let's call it Buffett's Mag 5, did better than the Mag 7. And the Mag 7 was high because NVIDIA did 900%, by the way.
Sure.
Right? If you take that out,
Yeah.
a lot less, right? But here's the other thing. So Buffett still got you talk about stock, and it's not just him, right? It's Greg Abel, all those guys, Jane, and well, they're all doing it together. It's a team thing too, but still greatest of all time. The other thing is, if you had invested in Japanese stocks, the usual way to do it is you have to convert your dollars into yen and then buy Japanese stocks with those yen. The yen's gone down 50% over this time, right?
Okay.
So that would have been a big drag on, instead of a 273% return, it would have been something like 151%. Not bad, not as good as the Mag 7, but still, it's less than 273%. Buffett didn't have that drag because what did he do? First of all, he uses leverage to buy these stocks. He borrowed money from the Japanese people. He went to sold debt, in the Japanese bond market. He borrowed money from the Japanese people, used that money to go out and buy Japanese stocks. And so he didn't have any currency. There was no currency impact. As Buffett says in his letter, I'll read it out. They have no view on future foreign exchange rates. And so they seek a position that's neutral of currency movements, right? He's like, this is the best investor in the world. You think he could afford a fantastic currency trader, but he's like, I'm not playing that game, right? I'm just going to be neutral with respect to currency. I'm just going to buy these 5 Japanese companies, and they've done an average of 273% and no currency drag. That's why still the greatest of all time.
That is amazing. I got some few thoughts too. Speaking of the greatest generation of all time, 80 years ago, just this past weekend, the U.S. Marines raised Old Glory, speaking of Japan also, taking the island of Iwo Jima, one of the most famous photos of all time, and one of the more bloody, violent conflicts in the Pacific War that we had during World War II. So again, just thank a veteran and thank a lot of people. I was talking to our partners this morning. I spent mainly all weekend running around to basketball games, kind of the end of the season of basketball. And I think 80 years ago, that would not have been probably what I was doing, or a lot of us, the lives that we live and the freedoms that we have. So many people continue to this day, obviously, to help defend our country and make it the safest and best country that there is. And in my opinion, but 80 years ago, just the sacrifices that so many people have made the whole time. But just important to remember that, I think. Anyway, so with the thank you to the veterans out there for sure. But a couple of things from me, Berkshire is a $1 trillion market cap. I don't know the exact number. There's 5 or 6 or 7 companies. It kind of flirts around depending on the day, but they are up there. Since 1965, I guess that's maybe when he took over. That's probably why I have this. I think it's 65 he took over. Up an annualized 19.9%. That's his company stock versus the S&P up about 10.4%. So okay, 10% more. Here's the power of compounding, everybody. That comes out to a 5.5 million % gain. 5.5 million % gain versus the S&P, I'm going to use air quotes, only up 40,000%. So 40,000%, that's pretty darn good.
That's pretty good.
Except for the one over there, and that's the power of 10% more a year compounded from 1965 until just recently. Now, this is interesting. Buybacks last year were 2.9 billion. He actually did not buy back his company's share 2 quarters in a row. That was the smallest number of buybacks since 2018. The record was 21 billion buyback in 2021. Cash is up to 334 billion versus just only 168 billion a year ago. So I know what your take on that in a second. We'll get there. He said his company paid 28.5 billion. According to the Guinness Book of World Records, I'm joking, it's not that. But according to records, apparently that's the most any company's ever paid in taxes, okay, according to Warren. And a lot of that was because of their stock in Apple. They were selling some Apple. They made a lot of money on, paid the most in taxes ever. And this was the last one. According to the data, they were net sellers of equities 9 quarters in a row. Now, be aware, the S&P gained 8 out of those 9. I still think, they were buying when a lot of other people were fearful, so they're able to sell some equities on the way up. But nonetheless, sellers, 8 out of 9 equities caught me. But I guess the one I want to ask you about, Sonu, they're not buying back their shares anymore like they once were. So what's your take there? And then the high cash level that we're told means the end of the world is near. What's your take on high cash level? And then we'll probably wrap up this week's podcast.
for the buyback thing, I wonder if he thinks, because he's like a value investor, right? Maybe he doesn't think Berkshire is cheap enough for him to buy. Right?
He can't say that probably, but exactly. Yeah.
Take your cues from the master himself, right? Mm-hmm. But the cash is always very weird. To talk about, I know the headlines are always about like, oh, Berkshire's cash pile has gone up, right?
Right.
And
it has to be bearish. That's the second part to that conversation.
Yes, exactly. And part of the thing is that, like I just mentioned, he, like for his Japanese stocks, he didn't even use his cash pile. He just borrowed money to buy it.
Well, that's a very interesting angle. That's a very interesting
So the cash is sort of like, I don't want to say it's meaningless, but the other thing in his letter, he kind of explained it pretty well. Most companies, they first have to pay a cost when they produce their goods and things like that, and then they sell it. So they know what they costed, right? Berkshire is different because remember, he has Geico, right? He's selling insurance, right? It's an insurance company at the end of the day. That's how they get what he calls a float. They first sell. The cost is later through insurance claims and things like that. The cost doesn't. So he's collecting cash. And, one reason is insurance premiums have gone up too. So because they'll have a lot of cash, right? Mm-hmm. Because, we've had a lot of, episodes, catastrophes, things like that. I mean, still, for them, it's property liability insurance, but still. I think that's why the cash pile is going up. And I think it's very tricky to talk about Buffett's cash pile because you don't know what he's doing on the other side with debt. Or maybe we actually do know because he tells us. He's very open about it. But nobody looks at that side when they think about his big cash pile. So I think just looking at the cash pile is not going to give you a big signal one way or the other. But the fact that he didn't do buybacks recently tells you, I think, something a little more interesting.
Yeah, it does. Here's a direct quote from the letter. Despite what some commentators currently view as an extraordinary cash position at our company, the great majority of your money remains in equities. That preference won't change. So he's aware of the talk out there. What did I say it was? 334 billion. I mean, 334 billion making 4%, 4.5%. I mean, hey. That's not too bad either. All right, Sonu, we've probably gone plenty long. I think we covered everything we wanted to cover. NVIDIA's earnings are this week. We'll see. We got PCE, Fed's favorite measure of inflation on Friday. Anything else this week you're watching?
I'm going to California, so hopefully I'm not watching too much.
Good point.
I'm sure I'll be watching stuff. I cannot watch stuff, but I am looking forward to being in 60, 65 degree weather. Mm-hmm. That's what I'll be watching. I'll be watching for the sun.
Well said. That sounds good. It should be fun. And the joke is when you took your what was it? Your not leave. That's the wrong word. Sabbatical. Sabbatical was literally like when the yen carry trade unwound. I was like, Sonu, don't ever leave again. So everybody, if something goes crazy this week, we all
I'll be
know
back.
Who to blame, Sonu. So anyway, everybody, thank you again for listening to episode 124, Carson's Facts versus Feelings, Denominator Blindness. We really appreciate it. We've got some guests coming up, not necessarily next week, but in the future, in the near future, that you're going to love. Some repeat offenders, some new ones as things are working on. So that'll be a lot of fun. But with all that, we'll see everyone next week. Enjoy, I guess, March. Next time we do this, it'll be March. So that's we've still got some snow outside here in Cincinnati. I'm looking forward to that going away very, very soon. So with all that, everybody, see you next week. Take care. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.